Hey guys, in this video, I'm going to cover the top 5 tax deductions you should be taking in your new or existing business. If it's your first time watching, my name is Navi Miraj. I'm a CPA who creates content all over social media to help you save thousands of dollars in taxes. So if you get value out of this video, then please consider subscribing. All right, let's jump right into the content. So we've got the top 5 tax deductions you should be taking, all right? The first one is startup and organizational costs. These are two different things, startup and organizational. Let's talk about them. So startup costs are costs you incurred before you made your first dollar in revenue in your business, all right? So it's important that you keep track of these expenses, as you're starting up or ramping up to go into the business. These are costs that you might incur, 6 months to a year prior to, again, receiving that first dollar of first dollar of revenue in your business. So let me give you some examples, right? While you're, looking into starting this business, you needed to purchase a laptop. Let's say you have a restaurant that you're opening and you've got to train some employees. Well, before you were even able to earn a dollar in your business, you had to incur some wages, right? So wages for training, advertising, website costs. All of these are startup costs, and they are deductible as long as you're keeping track of them and you have the receipts for your business. So be sure to track them. Let's talk about organizational costs real quick. So these are costs that you incurred to organize or form your business before you had any sales. So examples of these expenses would be legal and attorney fees, right? So fees that you pay to an attorney or a CPA, for example. In general, this is for the startup and organizational costs. In general, you can deduct or expense these items for the first $5,000 of startup costs and the first $5,000 of organizational costs. Any amounts over those first $5,000 would need to be amortized instead of getting a deduction. If it's your first time hearing that word, amortize, basically amortization is just a fancy way of saying you'll get the deduction over a period of time instead of getting it all in 1 year. So the amortization period for startup and organizational costs is 15 years, so it's quite some time. So although you won't get instant gratification though, you still want to keep track of those expenses because you'll get them over a period of time. So a quick recap on that. If you have less than $5,000 of startup costs and less than $5,000 in organizational costs, deduct them all in the first year. If it's more than $5,000, then you might want to speak to a tax professional and make sure you prepare that tax return properly because there are some special rules, right? You got to amortize them over 15 years. All right. Number 2, cell phone and internet service. So, in this video, I'm going to assume that you just have one cell phone and one internet connection in your home. So, you can deduct the business use percentage of your cell phone and your internet costs, but you got to be reasonable here, right? I would think that anything over 75% would be, questionable in my opinion. Are you really using your cell phone and your home internet up to 75% for business, or are you actually streaming Netflix and, browsing social media and websites, all right? So again, be reasonable, but let's give you an example. So if you've got a $100 cell phone bill, and let's say your internet bill is $50 a month, right? So that's $150 when you combine those two. You multiply that by, let's say, 75%, and you're going to get a $110 deduction, right? And that's each month. So for the year, that's well over $1,000 in tax deduction. So this is a great way to get a tax deduction for costs that you're already incurring prior to even being in business, right? You had internet and you had a cell phone before you got into business. Well, now you get a business tax deduction for having those items, all right? That is a good transition into the third tax deduction, which is home office deduction. This is another great tax deduction that you would get for expenses that you're already incurring, all right? You're already paying to live somewhere now. So there are 2 methods, and I'm going to break them down for you. For both methods, though, regardless of which one you use, you need to calculate the business use percentage of your home. So you would measure the area of the home that you use for exclusively for business, and you'll divide that by the total square footage of your home. So let's say you have 100 square foot of office space in your home, and your home is 1,000 total square foot. All right, 100 square foot of office space divided by 1,000 total square foot of a home, then you get 10%. So if you're using the simplified method, and I'll explain that here now, you take the square footage of your home office and you multiply that by $5. So we just said $5 times the 100 square foot is a $500 tax deduction. And you can take the simplified method up to 300 square foot of office space that you use in your home. But if you go larger than that, let's say you have a very large home and you have more than 300 square foot of home office space, if you choose the simplified method, you're capped at that 300 square foot, right? So in that example, 300 square foot times the $5 is $1,500 tax deduction for each year. Going back to that point a moment ago, even if your home office square foot is, let's say, 400 square feet, you're still capped at the $1,500 because the IRS says, hey, we'll give you a maximum of 300 square foot if you use the simplified method. Now, what if you want to use the regular method, right? Let's say you have more than 300 square foot, or you want to use the regular method because you get a better tax deduction for it. Well, if you own your own home, you'll take the mortgage interest, insurance, property taxes, utilities, and you add all that up and you multiply it by your business use percentage that, I helped you calculate a moment ago when I said 100 square foot of business home office space divided by 1,000 square foot. That was 10%, right? That's your business use percentage. You can also, with the regular method, get a deduction for depreciation of your home. So something to think about using the regular method. Now, if you rent, you're not left out of this deduction. Actually, for renters, it's really good. Some of my renters get a higher deduction than some of my homeowners. So let me explain how this works. So you're just going to add your rent and your utilities together, and you're going to multiply that by your business use percentage. So let me give you an example. Let's say for the year you've got $20,000 in rent expense. Well, 10% of your home is used for home office, right? So then 10% of the 20 grand is $2,000 deduction. So if you're renting, don't skimp out on this deduction. It could be $2 grand a year for you. If you want to learn more about the home office deduction, then check out my YouTube channel and watch the video I created specifically that talks about the home office deduction. Here, I'm just hitting the highlights, right? This video is all about the top 5 tax deductions you can be getting as a small business owner. All right, number 4, the auto deduction. So again, you've got 2 methods here that you can use. But with either method, you need to make sure that you're tracking your mileage, and you can use an app for this to avoid keeping a manual log, right? So the app would use the GPS on your phone and track where you are driving to. I know that sounds a little bit scary, but then you can easily categorize them as to if that's business or personal. So let's jump into it. The standard mileage method is the first method that you can use, right? So what this is in 2021, for each business mile that you drive, you get a deduction of 56 cents. Now that may not sound like a lot, right? But for those of you that are traveling a lot for business, like realtors or like a traveling salesperson, you may easily drive 20,000 business miles for your business. And if you do the math there, 20,000 times the 56 cents, that's an $11,000 tax deduction that you'd be missing out on if you're being shy, or I shouldn't say shy, but afraid of taking the auto deduction for some reason, right? Now let's talk about the actual method. The actual method is a little bit more cumbersome, if you will, because you need to keep track and have good records. But you can deduct the depreciation of your vehicle, insurance, fuel, maintenance, and repairs such as tires, oil changes, all that stuff you can deduct. But again, you're deducting the business use percentage. I'll give you a general rule of thumb. The general rule of thumb is if your vehicle costs more than $40,000 and you drive less than 10,000 miles a year, you might want to look into the actual method. But if your vehicle costs less than that and you're driving more than 10,000 miles a year, usually the standard mileage method is the method that you should be using. Again, I have a separate video that I created strictly on the auto deduction. If you're watching on YouTube, you'll probably see the link for that pop up here in a second. If you're watching on some other platform, go to my website. It's navimirajcpa.com, and all my videos are there for you to watch for free. All right, number 5, I've kind of saved the best for last, the S Corp Election. So this is a super powerful strategy that kicks in when you have or you formed a single member LLC, for example, that can save you $10,000 in taxes. So When your business starts to become profitable, that's when you'll probably implement this strategy. And when I say profitable, I mean you probably have $40,000 or more in profit for this S Corp strategy to make sense. But what you can do is you can elect to have your business, your LLC, taxed as an S corporation for tax purposes, right? And what this does is this saves you money on self-employment taxes, which, if you haven't heard that term before, that's Social Security and Medicare taxes. Now, I've got an entire video on this strategy as well, so here I'm going to just touch on the highlights. When your business is taxed as a sole proprietor, and what that means basically is if you formed a single member LLC, then you're going to be taxed as a sole proprietorship. You pay 15.3% in self-employment taxes on the profit of your business. But when your business is taxed as an S corporation, you'll treat yourself as an employee and you'll only pay self-employment taxes on the portion that you're paying yourself a reasonable compensation for. So I'll give you an example. Let's say you have $100,000 of profit and you're being taxed as a sole proprietor. Well, then you're going to pay $15,300 in self-employment tax, right? 100,000 times 15.3% is $15,300. Well, how does that compare with an S corporation? Well, in the S corp, you're still going to have $100,000 in profit of your business, but what you're going to do is you're going to pay yourself, let's say 40% in the way of salary. So $40,000 salary, and then the rest of that profit you're going to take in the form of a distribution. That just means you're transferring the money from business to personal, right? So what happens? As a result of doing this, you're going to pay 15.3% in self-employment taxes on the $40,000 amount you took as a salary. So if you do the math, 40,000 times 15.3% is about $6,000. So you compare that with the $15,300 in taxes you would be paying as a sole proprietor, and if you subtract that, you'll get $9,000 in taxes, right? In tax savings, that is, right? 15,300 minus the 6,000 or so is $9,000 in tax savings. I'm not saying a $9,000 deduction, right? I'm saying a $9,000 tax savings. Now, this is a bit of a complex topic, and again, I'm just covering the basics here in this video. So be sure to watch a video that'll pop up here if you're watching on YouTube that explains this in detail. Again, if you're not watching on YouTube, you can visit my website. Again, it's navimirajcpa.com. And actually, now that I'm talking about it, let me just transition to my computer here for a quick second. So why am I bringing you here? One, if you scroll all the way down, you'll see those videos that I was talking about. They're categorized for you so you can watch them. And again, it's all for free. But if you scroll back up to the top here, if you're interested in learning more about these tax strategies, I'm in the process of developing a course, right? This course is going to teach you all the basics and give you a solid foundation. So teaching you strategies like, not strategies rather, but what's an effective tax rate, a marginal tax rate, what is an LLC, what taxes do sole proprietors pay. I'll teach you all of that stuff, but then I'll teach you the strategies and how to implement them. Strategies such as hiring your minor children in your business, the S Corp strategy, how to save $50,000 in your retirement plan in a single year as a business owner. And on top of that, I'm going to teach you how to do that inside of QuickBooks accounting software. So not only will you learn the foundation, not only will you learn the strategies, but you'll learn how to implement them in QuickBooks accounting software. So you'll actually have financial statements that you can give to, a loan officer to get a loan. Also, what you can do here on my website is form an LLC. If you learn something in this video, you want to form an LLC or make an S Corp election, you can do that with these companies. I've compared the top 3 for you, and I was interested to find, all 3 of these companies are great, but with Inc. Authority, if you go through them, it's my top pick. They'll actually form your LLC for you completely for free. So visit my website and you can click on this link to visit and be taken to Inc. Authority, all right? Also, I get it that in these videos, I just do a high-level overview of these strategies. You might have a few questions, so if you would like to, you can schedule a 30 or 60-minute Q&A session with me, and I'm happy to get into the details with you. All right. With that said, Again, coming up here up in a moment, if you're watching on YouTube, is another great video that, again, if you've gotten value out of this one, you're going to get value out of these too, right? So they're going to talk about the home office video. I'll link up there, and maybe the deep dive S Corporation video. I'll link that video as well. So with that said, guys, I really appreciate you watching. If you learned something, please do subscribe so that I can see you in the next video where I'll either be teaching you or showing you how to implement a strategy that can save you thousands of dollars in taxes in your business. All right. I'll see you in the next video.